This month, we have a chat with Deanna Ezzy. She's the top 100 broker nationally out of approximately 23,000 brokers for 8 years in a row. She has 12 years in the industry. She's the number one female broker in Canberra for 5 years. Winner of 2022 ACT Broker of the Year, Specialist Finance Group, winner of 2021 Best Regional Broker for the Advisor Better Business, and winner of 2019 BX Excellence, BX Networking Australia. More Than Mortgages is the winner of the 2022 ACT Brokerage of the Year, Specialist Finance Group. Started 5 years ago with a team of 2, now there's 11 in the team, and 98 5-star Google reviews. So Deanna, it's great to finally catch up and have a chat.
Yeah.
And I'm really excited today to meet you at your office out in Deakin. And we're, in your boardroom. We're going to just go through some questions that customers might ask you when they come and approach you for a home loan or an investment loan or so forth.
Yep.
So what are some things that people need to be aware of when getting a home loan?
There's so much that people don't know that I often say really should probably be taught in schools. The first thing that comes to mind is everyone has their own credit report. Probably 50% of people I speak to don't even know this. And every time someone logs online and looks at enquires on a credit card, they tick a box. Those terms and conditions that they've just agreed to that they, of course, haven't read, lodges an inquiry on their credit report. As a result, if you do that too often, your credit score will come down. And if it falls below 650, which is usually the cutoff for most banks, their systems will just auto-decline a home loan. Right. So that most people have no idea. So my first conversation with people, I've already done a credit report on them. I pull it up, I show them, tell them if it's a great score, why it's a great score and what they've been doing to make it great. And if it's a bit of a low score, I'll explain why and how they can fix it. So there's just so much. That's probably the first thing that comes to mind.
Just on that, just from personal experience and what you just said.
Yeah.
And I'm curious about this as well. There's a tool online, I think it was called Credit Simple, so I just signed up and then you can get your credit score.
Yep.
And I was just monitoring it, it went up, and then most recently I applied for a credit card.
Yep.
After about 5 years, I'm reconciling my kind of, my connection with money and going, okay, credit is okay if you manage it all right.
Yep.
And it chipped away a little bit, it was at 800 something and it went down to just above 800. I'm like, why is that? Why does it go down when someone inquires about you?
So typically an inquiry, whether you proceed or not with it, will show up. And prior to about 2 years ago, there's a lot more information now on a credit report than there ever has been before.
Yeah.
But two plus years ago, all you would see is the inquiry. So the bank never knew if you were actually going ahead with it or not. So they assume worst case scenario, yep, you're going ahead with it. I think it's a weird one because if someone's got no credit history, they'll have a really low score, typically.
Yeah.
And so sometimes I'll say to people, especially first home buyers, if they're young, they've never had any credit, I'll say, go and get a really small credit card, like $500 limit, cut it up, put it in a drawer, or use it and pay it back on time.
Yeah.
And what that will do now over the last sort of 24, maybe 36 months, there's what's called comprehensive credit reporting. So for every credit facility that you've got that's open, there's 24 months of history that shows.
Right.
So it'll tell them at each month whether your payment's been made on time. You have to be more than 2 weeks late for it to show up as a 1 will show up for between 2 and 4 weeks late.
Yeah.
So anyway, if you do get a credit card and you're up to date with your repayments, then that'll actually boost your score. So You'll get a good score.
Yeah.
But the initial inquiry on it or proceeding with it usually will drop the score a little bit. I don't really know what the logic, I get it. I know what the logic is. If you're applying for multiple cards over and over again. And there was this like phase where everyone was applying for Qantas points, or they go, I've just got to keep this card for 3 months and then I cut it up and get another one. And they were doing that every 3 months. They'd come to me after 12 months of doing this, asking for a home loan, not having any idea that their credit score was severely damaged. What that looks like to a bank is you've borrowed 15 grand or whatever the credit card limit is. You can't afford to pay it back, so you've had to do a balance transfer to another credit card, and so on and so forth.
Right, so on paper it looks very different.
On paper it can create a story that you can't pay back your debt, so you're borrowing more debt to pay it back. So that's why if you apply for credit cards or personal loans, car loans, any sort of anything other than a home loan, if you do it in quick succession, it'll damage your score quite a lot.
Right. So it's good to be conscious of this when you're...
Huge. They need to teach it in schools. I don't know why. They don't.
They didn't teach me.
They did not teach me.
I had to find out the hard way.
Most people do. They go, I just applied for a car loan and I got knocked back and I got told my score was 500 out of 1,200. By the way, the free ones that you get are okay, but they're not the ones that the banks look at. Equifax, if anyone's looking, it's a monthly subscription of, I don't know, $10 or something, and you can get a monthly update on your score and credit reports and stuff, or just come to me. I can get them done for free. We do one for everyone that books in for an appointment because I like to look at that. And often people forget about a card that I forgot about, a $12,000 Harvey Norman card that I had from 10 years ago. And then I saw it on my credit report and I was like, oh, I completely forgot about that. I should probably call up and close it because there was nothing going on it. So that's the first. I don't even remember what your question was.
That's okay. But my question was in terms of the
what do people need to know?
In terms of the score, it goes down. But what do they need to be aware of when getting a home loan?
Aware of, you have a credit score and that paints a picture of who you are as a borrower. I often joke with couples that other things will go into a credit score as well. I think there's the bank's credit scoring system, which is different to your personal credit score.
Right.
So that's another type of score.
So that's for the home loan itself.
So once an application is submitted, 95% of banks have a credit scoring system that happens within 30 seconds of an application being submitted. Things like if you're a single man, your credit score, or male, your credit score worse than a single female. So there must be stats to say that men are more likely to default on a loan. If you're a couple, your credit score better than if you're a single person. It shows you how many jobs you've had over a sort of 3 to 5 year period. That'll show up on your personal credit score as well. If you've had one job for 5 years, your credit score better than if you'd had 5 jobs in 5 years.
So would that be the same for contractors? Because contractors are constantly moving around. And
similar. It depends if they're with one payroll company.
Then
that looks better. So it's not, some of the, I suppose, computerized way of scoring is not perfect. Sometimes I've seen scores really low and I can't figure out why.
There might be a debt.
It'd show up.
It'll show up.
So there's I've got a contact who retired last year, but he's one of these people that can't actually retire, loves a chat. He's like the oracle when it comes to credit repair. So anyone that's got a low score or there's something on their credit report that's hindering them from getting a home loan, I'll put them in touch with him.
So he's like the wolf
He's like the oracle. He knows how to fix credit reports. He'll introduce. So there's things, if people are worried, if they've sort of got a credit report and there's, even like a bankruptcy will show up on it for 5 years. A default will show up. Defaults, that's when it has to the debt gets picked up by a collections agency. So the debt has to be unpaid for a long time, probably 6 months-ish. And then someone like Baycorp or something will pick it up. That'll show up
as a phone call from someone.
Well, you should have received a lot of phone calls before that. And I think that's why banks think by the time it gets to a default position, you've just ghosted the bank. So that sort of paints a history. But credit scores in general, people just have no idea about, and that makes a massive difference. Sometimes, so any score, the general rule is any score below 650, most of the bank's credit scoring systems will just auto-decline it. So you can't even approach those banks. There's a small handful of lenders that are still decent lenders. The interest rates and everything are still the same. There's 3 of them that I use most often if the score is under 650. They're a bit more lenient. They look at it. They don't have a computer. It gets in front of a human and they actually look at it and go, well, hold on, what's the story behind this? They'll use a more logical common sense type of approach. Has to make sense. Can't just be, I forgot about it.
Yeah.
That's not going to work.
A couple or individual has a lower score.
Mm-hmm.
There are ways to repair that. There are ways they can definitely... But it might take a little bit of time.
Yeah.
Yeah.
So I've had clients, multiple clients that have gone through maybe separations, and then they would, there's probably been a good handful of clients over the years that have gone through a separation, were told by their lawyers not to pay the debts.
Right. Yeah.
And then that's kind of caught up with them, and a default's been lodged. You can actually get credit repair agencies to negotiate with whoever the debt is with to get it removed. There is a cost with that, but the cost is usually a lot cheaper than paying a higher interest rate because you've got to go to a bank. There's non-conforming lenders which have an appetite to take on more risk. So if you've got defaults and bad repayment history, they'll give you a loan, but it's way too expensive. Yeah. I don't do any of them really. I'd prefer someone just to pay a couple of $1,000, get their credit report fixed. That can take anywhere from 3 to 12 months to get your credit report fixed.
Yeah.
Otherwise, sometimes people have just missed payments and just forgotten about it. I had someone recently, I think her NAB credit card from memory was overdrawn by like $3, and she kept missing that payment. Like most of the card, it was something like $3. It was ridiculous, but because of that, she'd had these ones all over her credit report, which means she was 2 weeks late every month.
Yeah.
And when I brought this to her attention, she was like, I don't even know what you're talking about. And then it wasn't until she went back through her NAB. Actually, that's right. She was getting a text message from NAB saying, which to her was her reminder to pay it.
Yeah.
It was NAB saying, you're basically severely overdue. So she just went, oh, they forgot. They stopped sending me text messages. I completely forgot about it.
Yeah.
And even that, if you've just got missed payments and that's not a huge deal, the best thing to do is stop applying for credit. Keep on top of everything. I keep saying to people, try and keep buffers of cash in whatever payment, like repayment account. You might have a bills account where all your bills come out of, or a credit card or something.
Yeah.
Have in your head that $1,000 is zero. So that way,
that is your new zero.
Yeah. Try and program yourself to believe that once it hits $1,000, you've got to put more money in it.
Yeah.
Or something. Have a bit of a buffer in it.
Yeah.
Because I get it. People don't want to have access to too much money in one account because then you've got to be really disciplined to not spend it.
Yeah.
So a lot of people are like, oh, I've got all my savings. I've got 50 grand in this other account. But the bills account, things are bouncing because they don't want to keep too much in there for fear that they're not going to be disciplined enough to spend it. So you got to be really careful and mindful of where your money is, and just try not to let things bounce. And
it's I think it's easy. I've been through financial hardship, had to repair the credit and so forth, and it's easy to lapse, and it's easy to go into your old habits, and it's really creating new habits.
Or pay someone to do it. So when I started the business 5 years ago, I was sending out these emails. Actually, comprehensive credit reporting must have been about to come in, so I was letting everyone know my database. Hey guys, got to keep up to date with your repayments. Don't overdraw your accounts, even your everyday spending account. If you're overdrawing it by a couple of cents every second day, the bank will not like that at all.
Yeah.
They sort of think, if you can't manage $10 in your account, why would we give you, $500,000?
Yeah. That's right.
Anyway, I get a thing in a notification saying I've missed a $67 car insurance payment.
Yeah.
And I was like, oh, and of course the money's just in a different account, and I was just so busy. I'd started the business, and anyway, long story short, I ended up using this company called Bill Butler.
Yeah.
They don't pay me. I thought, I'm going to use these guys so they're a butler for your bills.
Yeah.
They'll work with busy professionals that just need someone to manage it all for them. They'll work with people if you have a savings goal and you just suck at savings yourself, you can work with them. So if you're like, I want to buy a house in 2 years, or we've got a wedding coming up, or both, they'll work with you for that. And they'll also work with people that need to pay off debt.
Yeah.
So those are the 3 types of people that they work with. I fell into number 1. I was just busy and didn't have the time or the headspace to be looking after all of the finances at home. So I thought, I'm going to do this for 6 months and just see how it goes. And now it's been nearly 5 years. I will never ever go back to managing it all myself.
Okay, and then you're recommending them that there's nothing in
huge.
it.
Nothing. They wanted to pay me referral fees at one point. I was like, I don't need you to. I'm just going to tell people about it because
you've got value out of them.
And I think they cost $50 a week, so a couple of grand a year. But I thought, if I to me, it was really worth it. Just I bought back a lot of time.
Yeah.
Also, all my bills get delivered to them, so I don't. It's kind of bad. I don't know what anything costs these days, but I don't get any bills. So you know when all the bills would arrive all at the same time, and it's just like, oh god, that's a bit depressing. Like it's just depressing.
Yes.
I don't get that.
So you don't have that feeling.
No, don't have that feeling. So like headspace is nice. It's so nice to know that there's money in this account that I don't see. They pay all my bills on time, which is important. And there's a buffer of cash there. And if I need the cash, they have to give it to me.
Yeah.
But
It's your
I
cash.
have to. But there's a level of what's the word? So I have to sort of say to them, "Hey, I need this money," and if it's going to affect a payment 6 months down the road, like car rego or something, they'll say, "Well, if you take this money out now, you're not going to be able to pay a car rego." There's like no buffer there.
So it's like having a financial controller for your
kind
life.
of. So they'll still have to give it to you, but it stops you from being impulsive.
Yeah.
With money. So I love them. Highly recommend. If you're not great with money or you just don't have time, do it.
We'll put some links down there if you're open to it.
Totally.
Just around this video.
Yeah.
I just want to move on to another question that people may have for you. What kind of things can people do to avoid the pitfalls when they're servicing their loans? And you might have touched on some of these in what we discussed.
Don't have massive credit card limits. The banks will determine your borrowing capacity, assuming that the cards are maxed out, even if they're not. So even if you pay your credit card off every month, or if it's just thrown in a drawer and you don't even use it, the bank assumes that tomorrow you can go out and max it out if you wanted to. So they allocate a payment of 3% per month based on the limit of the card. So if you've got a 10 grand card, they'll deduct $300 a month from your net income.
Yeah.
Just for having that card. So if you've got 50 grand's worth of credit cards, that's lots. 15 is that $1,500? I don't know, I need a calculator, but that they'll take off your income, which will severely reduce your borrowing capacity. The other thing that's been a big deal over the last sort of probably 5 years now, and it never used to be, is living expenses. So banks are highly scrutinising what people are spending their money on and how much. And back in the day, not long ago, you didn't even have to tell the bank what you spent on anything because they just said, if you're a couple with one kid, we're going to allocate whatever, $4 grand or $5 grand a month at a minimum. And that was the end of the discussion. Government decided that we need to be doing more sort of digging into that. So now it's like there's a 16, field different categories that you've got to fill out as far as what you're spending your money on every month. And majority of people have no idea. They grossly underestimate what they're spending. Yeah. And it's everything. It's everything from going out for dinner to going out to the movies to just, retail to anything.
So assessment of your financial, like your spending.
Yeah, so we have to go through 6 months worth of bank statements.
Right.
We have a piece of software, thank God, that does that for us. And just have a look at that. So I think if you're preparing to go for a home loan, just start being mindful of what you're spending your money on.
Yeah.
Again, Bill Butler works wonders. I've referred a few people that are like, oh, we don't know how to do this ourselves.
I guess they will track what you're spending on. Because
it's a bit of a process to get set up with Bill Butler, and one of the parts of it is really working out all of your bills, how much you need for groceries every week.
All right, so we've talked about people, what some of the pitfalls that people can avoid. What if someone's already got a loan and they're servicing one, maybe two more loans?
Yep.
How can they be confident, and I've approached you about this, how can they be confident that their current bank provider or financial provider is giving them the best rate and service?
There's two ways you can have a quick Google search and just have a look at what other rates are out there. Usually the rates that are advertised on Google are for like big loan amounts, low LVRs. So often the ones that are advertised are probably not what you're going to get, but it'll at least give you some idea as if you're in the ballpark. If you're not sure, either come to me or a broker to have a quick review, or go straight to your bank and just tell them, just say, hey, I've been speaking to a broker and they've offered me a cheaper rate and I don't really want to switch banks.
Yeah.
Banks completely frown on me, I think, saying this, but that's what I tell everyone.
Yeah.
Is can you drop my rate? And if it's high, they'll drop it. If you just don't want to talk to your bank, you don't have the time, come to me and we'll do it. So I can talk to most banks on your behalf, even if I haven't done the loan. I typically need a screenshot of your loan so I can see what's owing, the BSB and account number. And then I approach the bank and say, hey, if you don't drop their rate, I'm going to refinance them to another bank.
Yeah.
And they 90% of the time will drop the rate.
Is there, I guess, from a credit reporting perspective, is there a problem in swapping home loans and moving around?
Well, that just getting a review and asking your own bank to drop your rate, that doesn't do anything as far as like your credit report is concerned. But let's say you're with CommBank, you ask them to drop the rate and they go, oh yeah, okay, I will, but it's still not really good. And it's worth refinancing to another bank. That will have, yes, there will be an inquiry on your credit report. Home loan or mortgages, inquiries don't really do too much damage to your score. It's usually the personal debt, like the credit cards and car loans and personal loans and stuff.
Yeah.
Plus, it's quite unlikely that you're doing home loans in quick succession unless you're an investor.
Yeah.
The majority of people I speak to, really might be refinancing once every 3 years maybe.
Yeah.
But yeah, refinancing it's fine.
So typically the life of a loan might be about 3 years.
Yeah, it's getting shorter and shorter.
Yeah.
Just in the last 6 months, we've had the biggest, I think a newsletter I'm sending out today, the biggest on history refinance 6 months period.
Right.
Yeah.
Wow.
And it doesn't help that it's good and bad, but a lot of the banks are offering massive refinance rebates. But the problem with that is it's kind of, people are just jumping for the refinance rebate, but then they're not going to stick with that bank for very long. So the banks that have a bit more cash can offer bigger rebates. So I think it's kind of a bit unfair for the market, I think. Yeah. It's great because you can switch banks and pick up $4,000.
So at the end, it might come down to service, right?
But banks are basically whoring themselves out at the moment. So I think that's partly, and also too, rates have been going up. So people are, much hyper aware at the moment of what their rates are doing. I'm in the process of refinancing my commercial, this place, because I can save $10,000 a year. Yeah. But the first port of call is always going back to my current bank. And I do this for everyone. So even if you came to me with your loans, which I haven't organised, I think we've done this. I'm like, go back to your bank, ask them for a cheaper. Yeah.
And they did.
And because there's some brokers out there, and even banks, I think, that will just go, yeah, I can refinance that. Here's a cheaper rate. But not knowing that, well, hold on, if you just have a 10-minute conversation with your current bank, it'll save you the hassle of having to refinance. Because it's a lot of paperwork and time.
Yeah. We were paying 6%. And
that was a while ago too.
That was
way too much.
We'd been with the bank for I won't mention the bank, but 10 years. I was like, well, why are we paying this much?
It's a loyalty tax. Did I tell you about that?
Yeah.
Yeah.
You've been with
I'm pretty sure it was the Australian Financial Review did an article on what they called a loyalty tax. And I was 100%, they've put a name to it. If you stay with your bank for too long and don't know to approach them every 12 months to say, hey, drop the rate, somehow your rate will end up way higher than what they offer new people.
It
right?
doesn't make sense.
100%.
It should be the other way around. It's like, okay, we're going to send out a letter saying we've reduced your rate because you've been with us for 5 years or 6 years or whatever.
Yeah.
So,
which the benefits too of working with a broker is that a good broker should be doing a review of your loan every 12 months. Or it should be clear to the person. So if I'm dealing with you, I would say to you, by the way, after we set this loan up, contact me anytime if you need a loan review. If I'm doing my job correctly, I should be touching base with you every 12 months to check in.
In the calendar just kind of pops up.
Well, my system doesn't, because we've got lots of clients. I couldn't do it, But our system sends out an email and maybe even a text message and says, hey, Harsha, send me your screenshot of your account. I'll approach the bank. Tells you what to do. Yeah. You just email me, I'll get it done. Yeah. And that way, you've got the best chance of staying with the same bank for a long period of time. But,
because it's a big process. You're going to go from
it is.
You'd want to stick around. So, when people approach you, what are some of the typical questions they ask you when they approach mortgage mortgages?
How much can I borrow? Well, it depends on what it is they're wanting.
So is it investment loans or is it home loans?
Okay, so I'd say we probably do 70 to 75% of home buyers, whether that be first home buyers or upgraders, and probably 30% of investors. Used to be the other way around for a long time. For about 7 years, I was mainly focused on investment lending, complex lending. When I started my own business, I decided to switch that just because there's a lot of work that goes into that and I had no money. So I was like, I need to think about this from a business perspective. But I'm very well versed in investment lending and I actually really enjoy it. But majority of it's owner occupied at the moment.
Yeah. So, and what do you think? What do you think the customer's worst nightmare is in terms of loans when it comes to loans?
I think. So I've seen recently, because rates have been going up so fast over the last 6 months. It's really affected people that have locked themselves into off-the-plan properties. So off-the-plan, for those that don't know, are properties that are not yet built. So people will lock in a contract probably 1 to 2 years before the property's built. That contract has locked them in, yet they don't know what their situation's going to be in 2 years' time. They don't know what interest rate's going to be in 2 years' time. Like, there's a lot of risk with off-the-plan, I think, especially if it's quite a way away. We had one recently, single mum. Everything worked when we originally spoke. I think it was only a year that she had to wait for the property to be built as well. Everything was really good and actually had a little bit of wiggle room. And of course, rates just have gone up so much that every time rates go up, her borrowing capacity kept coming down. And of course, builds kept getting pushed back because of the war and COVID and all these things. And so interest rates going up and her build getting pushed back.
Actually, the property being built?
Yeah, the property being built, was meant to settle 6 months before it did.
Right.
And I feel for her. I feel for a lot of people, actually, because all of if their properties have been built when they were supposed to have been built, they would have locked in a much cheaper rate to start with, and they wouldn't have had the stress of worrying about whether or not they can afford the loan. So every month we would talk. I'm like, where's it up to? Are we ready to settle yet? Like, has it been completed? Because rates have gone up again, and we had to switch banks 3 times because every bank, basically her borrowing capacity, she no longer serviced the loan. It got pretty stressful there for her. I've never ever in 12 years had anyone lose a deposit. That was probably the closest that we got. And
how much are we talking in terms of the
10% of the value of the property?
Right. Okay.
Yeah.
So it's not
so I think hers was like 500. Hers was like 50k. Single mum, it was a lot, you know. And for her, that she just never would have been able to get out of the rental market. We got it done. But now I feel for her because the only lender that would do it had a slightly higher rate than what we could have gotten had the property been built when it was ready. And she's kind of stuck because now rates have gone up even further. She can't service a refinance. So she's stuck with that lender.
For a while.
For that, we've just done a rate review for her and dropped the rate down a little bit. But aside from that, there's nothing she can do. So that's probably the scariest thing for people is, you know, it's when the world changes, I think.
You can't predict some of these.
You can't.
You can't predict the bush. Well, maybe you can predict the bush fires nowadays, but you know, COVID,
war, all that sort of stuff was, you know, and just with what the economy. Like, rates haven't gone up like this in 15 years, maybe. So it's kind of unprecedented for a lot of people now that are buying. It's never happened before. Rates have been consistently coming down ever since I've been doing this, which is 12 years. So it's been a long time since rates have gone up, and especially this fast. So I think that's probably the biggest thing that freaks people out, is like the worst nightmare scenario of buying an off the plan. Everything changes. I've had it in the past. This was kind of their own fault, for lack of a better word, but it was a couple, husband and wife, bought a property off the plan, and then they came to me, and by the time the property was due, he'd accidentally knocked her up with twins. And so now they were a family of 4 on a single income.
Ouch.
Didn't work. I was like, there's no way, like, the bank's not going to give you anything. Like, according to the bank, you can't even afford to live, basically. Didn't say it like that, but, you know, and they had to on-sell that property. I don't think they lost the deposit, but that was, you know, that's heartbreaking for people. So
circumstances change.
So try not to scare anyone off from off the plan, but you need we talk to a lot of people before they will lock in an off the plan purchase. So even a year or two before, don't feel that it's a silly thing to be talking to a broker. Talk to a broker as well, because banks have one set of policy. At least with a broker, they can go, look, I've got 5 options, and if interest rates they can adjust things. You know, we've got calculations. We can say, if rates go up by 2%, and as long as your income doesn't change, yep, it'll still work.
Yeah.
And I'll say to people, don't get pregnant. Don't get another car loan.
Yeah.
And I'll say to people, if you're, I've had it before where a client hit a kangaroo and rode her car off, and she's like, I don't know whether to spend my money, which is going to be a deposit for the property that I'm waiting for to be built, or do I get a car loan? Like, what do I do?
Yeah.
And so I tell people, if anything like that happens, come to me and I'll work out what I think you should do. So.
And for those that are wondering, variable versus fixed, is there a lot of loans that go on fixed rate?
Right now, not heaps.
Yeah, because it's high.
But the variable's catching up.
Yeah.
So it's starting to shift a little bit. I don't know, 3 months ago when rates were 1.5%, variable rates were about 1.5% cheaper than fixed. Whereas now you're only about 0.5%. And if rates go up again next month, then you're only a quarter of a 0.25. So they're getting really close to what the fixed rates are. So I had a conversation yesterday with someone going, it's so hard to advise because I'm like, I don't have a crystal ball.
Yeah.
But they're going to lock in for a year, which was a no-brainer because they're at the same bank, but the 1 year fixed rate was a smidge cheaper than what their variable rate will be when their fixed reverts to variable.
So you can lock it in for certain periods of time.
Majority of people will lock in for 3 years.
Yeah.
2 years is the cheapest fixed rate.
Yeah.
3 years is typically the next cheapest. Then there's 4 and 5 years, but not. I've been burned a couple of times personally. So if you've got a fixed rate loan and then you want to discharge that loan, so if you want to sell the property, refinance the property, then you have to discharge the loan. And if you do that while it's fixed, you'll probably get charged early repayment fees in the thousands. So the last time I did it, I decided to go for a 5 year fixed. It was 3.99. I was like, never seen rates in the threes. They'll never go any lower. Locked it in for 5 years. And then I started my own business and I needed to get equity out of my property to help fund my business. And I had to get a business loan. And in order to do that, I had to switch banks.
Yeah.
So I had to discharge the loan. I paid about $5,000 in early repayment fees, and it wasn't a massive loan either. So you can be stung. The worst I've seen, someone was going through a divorce and wasn't actually a client of mine, and they had a 10-year fixed rate. I've never
10 years.
10 years too long. You just don't know where you're going to be.
Yeah.
Their early repayment fee was $130,000. That's how much. That was the fee to break the loan. That's why I do not put people into 10-year fixed rates.
Right.
It's too long. 5 at the max, but 3 is a good period of time, I think.
Was the loan a huge? I'm just curious. Was it?
I don't think it was. It might have been 700-ish.
Right. Okay. That's a pretty hefty.
But they'd fixed it at like 8 or 9%.
Yeah.
And by the time they wanted to break it, rates were at about 5.
Yeah.
And so the bank's like, well, I'm going to lose 4% for the next 5 years.
So they're just doing the calculations.
And they work out, the bank has to look at the cost of the wholesale funds. So the bank will go overseas, buy money for, I don't know, let's say 2%. And then the bank will take that money and sell it to Australians for 3%, basically. So they'll look at what they purchased the money for, how much money they were going to make. And then if it's going to cost them anything for you to break the loan, they pass that cost on to you.
Yeah.
Yeah.
In terms of, so if people have a loan or going into getting a loan, investment loan, home loan, whatever it is, mortgage insurance, is that a must, and how would you approach this?
So mortgage insurance does not insure you, it insures the bank. That is payable if you have less than 20% deposit. So that was a government initiative back in the 80s, I think. The government pretty much said to banks, okay, well, if you want to lend with less than 20% equity in the property, it's a higher risk, because if the borrower defaults on the loan and we need to sell the property quickly, we can't just drop the price by a lot to get rid of the property and sell it and recoup the cost. So we're going to have an insurance company insure that money. So if I get a loan for someone at a 90% borrowing ratio, so 10% equity in the property, there's mortgage insurance paid on that. If that borrower defaults to the point where the bank would have to sell and repossess the property, the insurance company will pay back the bank and then chase the client for the money. So what that does is it protects Australia's AAA credit rating, which means that Australia can go overseas and buy money cheap.
Right. So is that that's a cost to the bank, or is the cost to the person?
Cost to the borrower.
Right. How does that work?
So if if someone comes to me and doesn't have a 20% deposit, which most people don't, I don't buy my properties with 20% deposit for the most part. 12% is a sweet spot.
Yeah.
So you borrow at an 88% loan to value ratio, which is 12% equity in the property. And then the mortgage insurance gets added on top of that 88%. So it's just under 2%.
Yeah.
So what you'll find is you'll end up with 10% equity in the property.
Yeah.
2% is you've borrowed. The bank will give you the money, and then you use that. The bank will pay the mortgage insurer with that money, and then the rest of the money is used to actually buy the property.
Okay.
Yeah,
so that doesn't, like you said, that doesn't insure the borrower. So if the borrower is unable to service the loan,
it insures the bank.
The insurance company won't.
So you're thinking of, I can't even think of what it's called.
So this might be a personal income protection type.
Yeah, there's a type of insurance. You can get like a mortgage repayment insurance through the bank to just cover mortgage repayments if something were to happen. But I've always steered people towards talk to a financial advisor and have a look at income protection insurance, because then if you hit your head or you can't work, then you've actually got money to service all of your stuff, not just the home loan.
Yeah, some credit cards used to have a insurance which would allow you to repay it. So
right,
that's what I was asking.
No, so mortgage insurance or lender's mortgage insurance or LMI, that covers the bank. So that's payable if you've got less than 20% deposit. And then the other type of insurance, I would just say have a look at getting income protection insurance to cover the mortgage repayments. And just keep a buffer of cash in the bank if you can. Keep it in an offset account.
Rainy day fund.
Rainy day.
Yeah.
That way when rates go up, you don't have to panic completely. It sucks because you'll see your buffer money, dwindle a little bit.
Yeah.
But you don't have to, sell the house or anything.
Yeah.
Yeah.
So we've been through bushfires. We've been through a whole lot of smoke in Canberra.
Yep.
We've been through almost 3 years now of COVID. What do you see in 2023? Do you see things getting better?
Aside from the severe hay fever that I have right now, which, by the way, is apparently unprecedented, the pollen count as well as the length of days in a row. I'm like, typical.
Now the vegetation is attacking us.
It's crazy. I live on 16 acres surrounded by grass as well, which doesn't help. So I'm feeling the effects. 2023, I think, this is really a gut feel. I have a feeling rates will go up another 2 times at least. So not the next couple months. I think by March, rates will start to stabilise. So I have a feeling by the mid next year, rates will stabilise at maybe around 6%, which sounds horrendous, which is 3 times what rates were, 6 months ago almost.
Yeah.
But what will happen is next year, I think market sentiment, once people know what rates are doing, they tend to relax and go, okay, cool. Now we know we can go and buy stuff. The market should drop a bit as far as property prices go because literally people can't afford it. Borrowing capacities will come down drastically. The economy will slow down because people don't have enough money to go and spend. But there's a lot of people still on fixed rate loans at 2%. And they're still on fixed rate loans until about 2024.
Right.
So I'm thinking rates will kind of be at around the maybe high 5s, 6 for maybe 12 months or so. And then when all of those loans that start coming off from 2 to 6, that is going to, I think the government's going to wind it back then, which I've been told by people that have been doing this for, in the industry for 30 or 40 years, that's typically what the government does. They usually swing the pendulum a bit too far. They realize, that's a bit too much, and then they'll wind it back. So I feel like by the end of 23 or end of 24, we might be in the low to mid 5s. And I feel like that's where we're going to sort of stay for a while.
Yeah.
Who knows? Let's see if my crystal ball.
Yeah. So Deanna, you're based in Canberra in Deakin.
Yep.
More than mortgages.
Yep.
Your office is in Deakin, and if people want to approach you, do they have to come and see you, or can they phone you if they're in another state?
Oh, I do heaps of appointments outside of Canberra. Zoom appointments. I, at one point, had 70% of my clients outside of Canberra before Zoom even. So a lot of it was phone and emails.
Yeah.
So I'm really used to dealing with people not in Canberra.
Yeah.
It's always nice to do face-to-face, but definitely don't have to. I'd say the bulk of everything now is probably via Zoom.
Yeah.
So, all over the country.
Yeah.
Yeah.
All right. So I'll put your contact details somewhere around this video so people can contact you.
Yeah.
Thanks today.
You're welcome.
For catching up, and I'll leave the invitation open. We may catch up again.